Hello and welcome to Nirma Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Shagata Bhattacharya, Chief Economist at Axis Bank, joining in. Welcome to the show, Shagata, and always a pleasure to speak to you and get insights from you.
Always a pleasure and privilege to be on your show, Hiral. Thank you very much.
Thank you so much. Thank you, Shagata. Shagata, my first question coming to you is, firstly, let's start off with the latest numbers that we've seen. In terms of IIP, the growth has moderated and it's mainly manufacturing which has been a drag. And secondly, if you see in terms of the CPI numbers that came in, they've slightly crossed the RBI's comfort zone. What do you make of these two?
So it is, I mean, it's not as if these numbers were very unexpected. So unlike the 0.4% IIP, we were at 0.8%, which is a very close call in terms of forecasting the IIP. And on the CPI inflation, my colleagues, they do a bang up job of their forecast. So they were at 5.9, it came in at 6. So it's close to expectations. So the economy is moving on projected lines, which is always a comfort because it's always the surprises which are difficult to deal with. So I think RBI is more or less, it's a little moderate in terms of its inflation projections for FY23. So unlike their 4.5%, we are at about 4.8%. Which is also very, very close. But the difference being that, the inflation thing is the more important thing now. The important thing is they say that the risks are balanced. To my mind, the risks are on the upside. So on the inflation front. So, the 4.8% there, RBI is 4.5%. Given where we are seeing crude is definitely going to come down from the current levels, but not by too much. Certainly the crude average is likely to be far higher than in FY22, going into FY23. And global commodities prices have also started rising. China has started a stimulus program. Demand remains very strong in the developed markets, which is why the Federal Reserve is reacting the way it is doing. Labor markets are very tight. Food prices are going up. And in India itself, this is where we come to the growth aspect, part of which is the near-term IIP number that you put in. So our growth forecast for next year is 8.3 in the range of the economic survey, but higher than the RBI's forecast. My own sense is that as these restrictions, COVID restrictions begin to come off, the pent-up demand that we have seen for a fairly long amount of time, particularly from the services, contact services segments, that will probably start kicking in. So the demand component will then start adding to the supply dislocation induced rise in input prices, etc. All the crude, the geopolitical tensions, and etc. So the demand component might begin to start kicking in as recovery progresses. So, so that's the broad growth inflation trajectory. On the specific IIP, it was expected in December, particularly coming in from cement, etc. Its demand still remains weak. That's one reason. One reason is, of course, one is the post the festival season output pickup, etc. We believe that inventory restocking has begun to start. But one more reason is that government spending, particularly on capex, has presumably remained weak in December, and that is what is leading to a bit of the tail of the production output, manufacturing, cement, metals, etc. That is beginning to that has shown up in the IIP numbers. So my guess is January numbers relative to if you take the base effects out, January will be even weaker. But from then on, our set of composite leading indicators that we track, 39 indexes, shows a recovery in early February. The data that we have for early February, we show a recovery. So that's the broad trajectory that we see.
Right. So, Shagata, would it be right to say that inflation would not be seen as a big threat, at least with regards to where the domestic economy goes? Because clearly, if you see in terms of the RBI as well, they've kept the rates on hold. They've decided to continue with an accommodative stance till growth recovers on a sustainable and a durable basis. So how do you actually coincide both of these then?
So, the RBI narrative is very consistent, whether one agrees with that or not. So growth they expect growth to remain moderate at 7.8% in FY23. And as a consequence, part of that, the resultant weakness in demand will then show up in the lower inflation numbers. So what the upside risks that we were talking about in terms of a demand recovery spilling over into parts of the CPI inflation basket, RBI expects that to remain moderate. Look, so even so the January numbers for the CPI is the peak that we see. So from then on, it's going to come down. And bumpily, but over the next 12 months or so, CPI inflation will be anywhere between 4.5%. So, I mean, to that extent, we are okay, unless crude begins to, rises to 100, 110, etc., and remains there for a long time. So that is a risk scenario. So from an RBI perspective, they're completely consistent on their ability to control inflation. They are probably correct that the global spillovers of inflation, given the composition of inflation, say in the US, used cars, mortgages, etc., will probably not be replicated in India. So to that extent, there is a delinking between US and India inflation rates, and provided the government has the fiscal levers, with excise taxes, cess on fuel, etc., to try to moderate, even if crude prices remain high, to moderate petrol and diesel pump prices. So to that extent, there is a little bit of fiscal room available. You've seen the excise tax collection projections in the FY23 budget being very modest. So presumably they have factored that in. So there is an extent, and then other customs duties on other food-related items can also be used to control some, if there is a rise in certain aspects of the food basket. To that extent, I think we are relatively reasonably okay with inflation. How this carries on, whether now we are more comfortable with inflation at around closer to 4% or closer to 6%, is something that we need to be careful about. One of the arguments that even Professor Dholakia in his previous the MPC membership, he used to argue that if India aspires to grow 2 percentage or 3 percentage points then higher than the rest of the global average, world average, the developed market growth rates, which is what we are targeting, say 7% sustained growth, then we should also be relatively comfortable with keeping the higher, the 2% above our target rate of inflation rate of 4%, which is higher, 2% higher than the developed markets. We should also aspire to keep that a little bit higher. So we should be comfortable with a 5% sustained inflation, let's say, for example, than a 4% inflation, which is okay. So that part is okay. So now the main thing for the Reserve Bank to do over the course of the next year or so, or at least the next 6 months, there is going to be a tightening in India's external financial conditions. The Fed, interest rates, BO, all the G10 economies in the world. The main central banks. So they are tightening in the pace. So to be able to control the spillover effects, maintain fairly stable financial conditions in India, and not allowing these rate hikes to seep, say, into bank lending rates, say, for instance, to any significant extent, that will be the challenge that the Reserve Bank will have to consider. The past record shows that they have been very, very successful in managing the evolution of interest rates, and presumably that expertise will also need to be brought to bear on the way that interest rates begin to move ahead. You know that, I don't need to say this again, that even with the reverse repo being held at this point in time, actual short-term market rates, particularly the funding rates, the T-bill rates, the CP rates, bank certificate of deposit rates, those have been guided upwards with the VRRR auctions, etc. So they have de facto managed the normalization process. Whether we actually need to signal via an increase in the reverse repo rate or not, it still remains to be seen. But anyway, they will do it in a very gradual manner.
Right. So overall, if you have to look at FY23 as a whole, how many basis points of a hike are you expecting? And secondly, will there be a hike in the month of April, or do you think it will be moved and pushed to the month of June?
So when you say hike, let's start with the sequence of the hiking process. So we had initially expected, we have been expecting since October actually, for them to be moving, and they will move. We thought that they will increase the reverse repo rate slowly, gradually in bits and pieces up to that 25 basis point gap with the repo. The repo is at 4%, so currently the reverse repo is at 3.2535%, I'm sorry, and then take that out in bits and pieces to 3.75, which is the normal gap with the repo rate. After that, they would change their stance from the accommodative stance to the neutral policy stance. And then after that comes the tightening phase. This is the normalization, going back to the pre-COVID levels. And then starts the tightening phase with the increase in the repo rates, the actual policy rates. That, to my mind, that sequence is no longer clear. So the going in April. So April, there's no chance of a repo rate. The repo rate hikes will only happen, if at all it happens, in H2 of FY23, say the October policy or the December policy or whatever. So there's no chance of the repo rate. I'm talking of the reverse repo rate. That let us wait and watch, because the signals that they have given in this policy, in the February policy, seems to suggest that they're okay with the, since de facto short-term rates have moved close to the repo rate, they're okay with a reverse repo at wherever it is. I mean, 335 or whatever, they're okay with this. So that sequence, I'm not very sure. The reverse repo and then the stance change. But the repo rate hikes are still pretty far.
Right. And with all of this, the dovish stance somewhere, yes, will be positive with regards to where the domestic yields are concerned. However, clearly the government actually sought cooperation of market participants for the orderly evolution of the yield curve, and suggested that the government, RBI's support, particularly via OMOs, will reduce significantly. So how are you seeing the trajectory on the yield front?
So that is the interesting part. So whatever happens to the policy rate, the short-term rates, and in terms of bond market participants, which many of your readers, listeners, or your audience are well versed with, what markets call the steepness of the yield curve, say the difference between the 10-year and the 1-year interest rates, say for instance, that had up, that curve had steepened very sharply over the last 2 or 3 months. Once the GSAP program and the OMO program, etc., was scaled down, was stopped, was scaled down. So it is a problem in terms of, I'm talking about FY23. Look, the remaining part of FY22, we are already seeing them managing. Yields have come off despite US yields having tightened. So Indian yields have come off. That's because they have cancelled 2 auctions. We expect that even the final auction, the central government securities auction, will be cancelled, might be cancelled. I'm not very sure. So let's wait and see. So FY22, they have managed. The problem was in FY23. Well, given the significant 14.2 lakh crores, 14.2 trillion rupees of gross center borrowing program, plus say another 10 lakh crores of state government borrowing, SDLs borrowing programs, that part is very large. So definitely, I mean, given the fact that RBI will have to manage this level of 7 lakh crores worth of excess liquidity, which will only increase over a period of time. So there is a demand-supply mismatch, supply of paper that's coming in versus who the potential buyers of this paper are. And since we haven't heard anything in specific about the bond index inclusion, which was expected to bring in a lot of offshore investors into the bond markets, there is a worry in the market. The key that they have, the key to managing this program in the absence of RBI not being able to support anything close to what they had done in H1 of FY22, might be the amount of surplus cash that the government of India is now currently in having stored with the Reserve Bank of India. How much of that cash drawdown they can use to offset the initial increase in supply. Normally, again, I mean, number 2, normally, as all of us know, that they usually front load that borrowing program 60% odd in H1, and then the remaining 40%. You're hearing market chatter that they might actually reduce that 60% odd and then try to push that later in the system, where more scope for additional buyers, etc., will come into place. So that's another way. So one is the cash, using the cash to reduce the amount of borrowings, then pushing the H1 borrowing program into H2, using WMAs, ways and means auctions, to smoothen mismatches of cash flows. Plus, there is a third aspect, the green bonds. So if they can manage a good pipeline of climate bonds, so sustainable programs, capex programs or whatever programs, say via railway electrification, in roads, I mean, using more plastics derived material, etc. So if they do that, they have a potential set, a very large pool of global buyers, even if they issue onshore, domestic issues of bonds. I mean, they can use the FPI routes to pull in some of these. So I think they will try to use these combinations to try to keep yields within this certain range. But be that as it may, the way that yields have come off, I mean, 670 or whatever, these levels look to be unsustainable because when the borrowing program starts, whatever the tools that they use to manage an orderly issuance program, yields are bound to go up from here. Very difficult to say whether it's 720, and I'm not a bond markets person anyway, so that is immaterial. But be that as it may, expectations of a normalization, expectations of a rate increase trajectory at some point in FY23, those expectations will begin to act on the government borrowing program. So yields are definitely likely to go up from these levels.
Right. And with all of this, Shagata, the other aspect that came out from the budget as well is that, yes, the government is pushing towards capex. Investments is what they're looking at, but we've not really seen too much come out on the consumption side. And secondly, if you see in terms of where fiscal consolidation is concerned, they've been pretty lenient in consolidation as compared to what everyone was expecting. So what's the sense that you pick up, especially on the fiscal deficit front? Because clearly, if you see the number that has come in at 6.4% in terms of FY23 that they are targeting, the gross borrowing number still seems to be slightly elevated.
So, couple of points. Let's take the second question first. In terms of the fiscal deficit. So obviously, so one part of the higher than expected, we were close. I mean, we were thinking about 6% odd. I mean, they came in with 6.4. Again, I mean, it's not an earth-shaking difference in the deficit. But again, there are two factors. So one is the quality of the deficit. I mean, the way that they're signaling that this deficit is more due to capex spending than the earlier years, as it used to happen with revenue expenditures. So one part is that. The second part, which they had started in the last, the FY22 budget, to try to clean up, make the budget more transparent, I mean, and take on board many of these off-balance sheet items that many of the government agencies were used to borrow from the markets rather than show up on the balance sheet. So they have taken part of that back into the budget, which they have continued into the FY23 budget. So that part that in terms of the fiscal deficit, so what used to be pushed off the budget in terms of CPSE, IEBRs, or whatever extra budgetary resources for the PSEs, public sector enterprises, and many of the government agencies, the FCI, NHAI, etc. So that's been brought on board. So that's one part of the additional deficit spending that they're thinking. And I think this is also consistent with the RBI, the thing that we started with RBI and the fiscal policy, the consistency story that growth still remains relatively wobbly, particularly in the lower deciles that need to be supported, where consumption demand needs to be supported. The top deciles are doing very well for themselves. I mean, there's no, I mean, so the growth aspect is going to be okay, but it's that consumption aspect from the middle and the lower middle income households is going to be a problem, which brings us to your first question, that should they have actually done something more in terms of consumption, I mean, stimulated consumption in the budget. Look, so again, in this, there is one thing that you must note, that it doesn't mean just because I'm spending on capex, that doesn't mean that I'm not supporting consumption, because that capex, that spending that you do with the big infrastructure developers, let's say, for instance, this begins to come down the value chain. I mean, the big developers then spend on their contractors, their subcontractors, and down the chain, right down to the MSMEs, which provide the nuts, bolts, the little things in the which oil, which runs the lubricants, which run the machinery, etc. So all of that actually, the credit push to support MSMEs. I don't know whether that will work or not. I mean, it did with the ECLGS program. So all the backstops, the guarantee programs, etc., for the MSMEs. Remember that the small and the micro segment of the MSMEs, this is actually the consuming class. I mean, this is the kiranas, the retails, the proprietorships, etc. That is actually the consumption class as well. It's not just the output, the commercial and the producing class. It's also the consumption class. This is where consumption is focused on. So actually, if the money is beginning to come down to these segments, it might take a little longer. Yeah, but I mean, capex does get spent somewhere. Money goes into somebody's pocket at the end of the day, and this, to my mind, is a far better strategy than pushing money directly. Of course, I mean, a certain segment of the household, very low income households, etc., they will need direct support. I mean, there's no doubt about that, because they are not in that ecosystem, MSME ecosystem. But the two are not completely inconsistent. So, I mean, there is one part of the capex which does actually move to support consumption.
Right. So with all of this, another aspect that comes in, Shaugata, is with regards to where, overall credit growth is concerned, because we're talking of government expenditure. Now, private expenditure becomes crucial as well. And secondly, credit growth basis that what we're expecting is that it could be in double digits. What's your sense?
Credit growth is difficult to be in double digits. I think so. So credit growth, let me qualify this. So the first thing that comes to mind with credit growth is banks. So one of the things, the old days of 15, 18% bank credit growth to support a 12, 13% nominal GDP growth, those days are gone. I mean, so one part is that the base itself has become much larger. So I mean, you have a credit at 110 lakh crores as opposed to credit at those points in time of 50 lakh crores, etc. So the base itself has increased. Secondly, alternative sources of credit other than banks, non-bank sources of credit, be it NBFCs, be it markets with corporate bond issuances, commercial paper issuances, etc. Those are beginning to contribute much more to the overall flow of funds for the commercial sector, for commercial and retail segments. So, I mean, it's just that the banks are lending to NBFCs for them to on-lend to other last mile customers and consumer and borrowers, which banks can't target themselves. So you have to look at that overall flow of funds numbers. But overall, from bank credit, I don't think even in FY23, we are looking for bank credit to cross, say, 9%, maybe 9.5%. If actual demand picks up, and large part of that will still remain from the retail segment, the consumer-led mortgage, personal loans, credit cards, automobiles, etc. That will still contribute a lot, but overall, it will be very difficult for bank credit loans to cross 10% even in FY23.
Right. And my last question, Shaugata, coming to you is, in terms of the excessive policy tightening that could happen, particularly in developed world, and that's what we are alluding to right now, seeing the way the Fed has been reacting, what China has been doing, Bank of England has been doing. Do you think that could be a major risk to a developing nation like ours?
I think it's definitely a risk. There is likely to be volatility, which you are seeing in the equity markets, not so much in the bond markets yet, but in the equity markets, in the foreign exchange markets. I mean, that here, the volatility you're already seeing. But I think we are nowhere close to the kinds of stresses that we saw in India, not just, and in many other emerging markets during the Fed 2013 taper tantrum. That happened. I think we are far more fortified. Our external situation, external balances are much better now. I mean, with the $630 odd billion in terms of forex reserves, our CAD, which is much more controlled, interest rates at relatively low levels, etc. So all of that, and inflation at relatively low levels. So I mean, the overall macro and price stability issues, which spooks foreign investors, I think many of those factors are much more moderate and much better, much more moderate than they were in FY13. Having said that, there will be some spillover in terms of market volatility. But this is where the RBI comes in with the various instruments, and the RBI's instrumentalities are far broader this time. I mean, the control of NDF markets to control foreign exchange, the instruments that they have, the CDS instruments that they're beginning to. So the control on the derivatives instruments, say, for instance. So their instrumentality is much higher, much better now. So overall, there will be a spillover effect, but I don't think, God, fingers crossed, God willing, that there's going to be an enormous effect of a Fed tightening. And by the way, the news that the signals that we are getting from the Fed, that very aggressive tightening, I have a feeling, and mind this, mark you, in after 2 or 3 large increases in the Fed, they are going to tamp down as well. Because growth there is already, you're already beginning to see initial signals of growth beginning to slow down. And if they tighten too fast, too soon, it's going to be the same policy mistake that they had done in 18, which forced them to cut back on rates. The same thing will turn out again later on in the post, I mean, say next 3, 4, 5 months of 2022. You'll see the same thing.
Absolutely. So I think these are the key things we should be watching out for. Thank you, Saugata, so much for joining us on the show. As always, a pleasure to get insights from you, understandings from you with the experience. Thank you. Stay safe and speak to you soon again.
Thank you so much, Hiran. Thank you so much. Always a pleasure interacting. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.